Hi everyone. It's been some time since our last video, so we thought we'd do another one just to update you on what's happened since the beginning of COVID. I know we put one or two videos out at that point. But firstly, we just hope that everyone is well, and all our regards go to all of you and your families. I know Alex also asked me to pass on best wishes to every one of his clients as well, and he would be quite upset if I didn't mention him in the video. So I think what we spoke about last time, it's pretty much played out exactly how we thought. We've been, I wouldn't say lucky. I think it's more level-headed than anything else, because of the way markets have reacted very quickly to come back. So the opportunities that had presented themselves came through very quickly. We did speak a lot about our bonds, our bond exposure, and why we took that view, and that played out very fast. In fact, we've since sold out and bought back again into bonds, so that's quite something that's happened very quickly. And then also just timing of our rebalances has been pretty good. You probably would have noticed there's been a bit of activity on your portfolios in the enhanced models. So we are very, very proud of what we've managed to achieve for our clients, and it just speaks to the way we do things, and it just kind of reinforces how we do things is actually the right way. And so I'm very, very proud to be able to report back to you as our valued clients that the model portfolios have done very, very well since the bottom of COVID, as expected. Even if I look back to the beginning of 2020, January, and we look through the speed bump of the COVID correction and up into today, our model portfolios, specifically referring to the moderate and the cautious, because those are the biggest ones, have done upper teens, almost 20%, between 15 and 20% over that period of time, which is really, really something considering there was a big correction in the middle. I don't know if you want to add anything to that, Dad.
Hi everyone. Just building on what Garth has said, and he's pretty much stolen all of my thunder, so there's not a heck of a lot I can say. But one of the principles that we speak about when we build our portfolios, it's very easy to get lured into, I call it the beauty contest, where you've got all the fund managers out there all trying to outperform each other, taking perhaps unnecessary risks or unwise risks in pursuit of growth and being a top quartile performer. So we have consciously, focused on building and managing outcomes-based portfolios. And really, the simple explanation for what that's all about is, we don't sell performance. We build and manage and sell plans. And I really don't like to use the word sell. You come and see us, you want to retire, we build a plan for you, and we make certain assumptions, like inflation and the growth that we need to ensure that your plan lasts for the amount of time you need it to last based on longevity. So we build portfolios to try and sort of flatten out the bumps. Warren Buffett, he thinks the same, although perhaps he doesn't say what I'm saying. But the common principle that underlies the way we do things is that we try and reduce downside risk, try and capture some, if not all, of the upside, but limit the downside. So you flatten out the ride, so to speak, remove those, or try and avoid the speed bumps, and manage the portfolios in such a way that your plans actually work. So that is a very, very important principle that is embedded in our philosophies. And in testing times like this, where we have had volatility, we've come through and your plans have stood up. They are resilient and they achieve the results that we set out to achieve.
Yeah.
Garth?
I just want to speak. I'd like to just raise one thing that everyone seems to go on and on about, and especially considering that we're back into load shedding and Eskom and politics and this and that. The theory is that our politics in South Africa are not necessarily linked to our market performance. And I just want to raise this point because a lot of us South Africans get very, very negative or very, very positive. We're not anywhere in the middle ever. We either hate the country or we love it. So just to raise this point, it's really been exactly as I've said it. So we hit COVID, the rand weakened dramatically. Everyone thinks it's doom and gloom. Now you want to run out the country with your money, even though the dollar or pound rate is so weak. You know, the rand is so weak against those currencies. You still want to take your money out. That could have been the worst decision you would have made. And even when I look back and I do an analysis on global equity markets, in fact, since the 24th of March last year, which is basically the very bottom of the market, the Johannesburg Stock Exchange has been the highest performing equity market in the world. In dollars, not in rands, in dollars. So, South Africa is all doom and gloom, blah, 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 and it's the normal story, but the opportunity was ever present. And fortunately, we were wise to the fact, and we took that opportunity in timing our rebalances. So I just want to further make the point, or labor the point, that when you think about South Africa and the economy and the politics, it's not necessarily linked to your investment performance. I don't know if you want to add anything to that, Dad.
So I think what also sets us apart a little bit from our, I hesitate to say competitors, but our colleagues in the advice market, is apart from the fact that we're using an outcomes-based philosophy, we are also extremely cognizant of an element of investment planning that many people either forget about or are not aware of it, or they don't know how to deal with it. And it's psychology. So, building a plan is one thing. That you can do with all sorts of tools, and you can do your projections of how long your money's going to last, put your estimates of growth in and inflation. There are any number of tools out there that you can do. And an advisor can actually impress a client by being able to do that and show people. But when the rubber hits the road, let me go back a little bit. So there are two things that affect investment markets: fundamentals and sentiment. So if we took sentiment out of it, which is the psychology part of things, if we take sentiment out of the equation and you just stick with fundamentals, you would have a fairly gently undulating kind of graph of performance, up, down, but nothing extreme. But when sentiment gets taken into the equation, you overshoot on the upside, you overshoot on the downside, and that's when people lose money. So let's look at two examples here. We look at the global financial crisis, 2008, 2009, and that was precipitated by reckless, cavalier lending. It was induced by greed in a way. It's an extreme term that I use, but I think it kind of encapsulates it. If you look at America, you look at these Fannie Mae and Freddie Mac, and they were set up to help people acquire homes after the war. And then come 2000, the early 2000s, after 9/11 and the tech bubble and all those things, then all of a sudden people were buying second properties and third properties, and property was a one-way bet. It was just going up. The banks were fostering that kind of thinking and lending against assets that were overpriced. And what happened? Things went pear-shaped, which inevitably they will, because there was a bubble of unbelievable proportions that developed. It took nearly 2 years. I'm not going to go into all the details, it's a topic on its own, but it took almost 2 years for that situation to, call it, correct itself, but that's how long the recovery was. So that was financially induced. Now we look at COVID. COVID just came at us out of left field. We didn't know how to deal with it. We'd never been posed with this kind of challenge before. it introduced an element of emotion that we had not felt. And what was the natural response to that trigger of emotion? You know, as human beings, we're programmed to be reactive. Our right brains dominate, and it's all around survival and reacting quickly. But in investing, you try and control that right brain function and your natural instincts and invoke things like logic and reason and rationality. Now, I recall a saying going way back in history, keeping your head while those around you are losing theirs. And if, as a client, you are engaging with a financial advisor, whether you know him well or just met him, you need to quickly get a handle on how he's wired or how she's wired, how they respond in extreme, challenging circumstances. Do they also get twitchy and emotional? And then that sort of feeds across the table to the client. And believe me, that is not a marriage made in heaven. That is just a recipe for complete disaster. We tend to be very rational, clear thinking. There's another saying, sleep on it, think about it. That's what we do. It's easier to be able to do that when you have the knowledge and experience, fair enough. But the impact of those emotional decisions, and we talk to a lot of institutions, a lot of the marketers for those institutions who are out there interfacing and interacting with advisors, and the common comment is, you don't know what's happening out there.
Yeah.
Advisors have been emotional. They took clients out of the market and put them in low risk money market type investments. And then the next thing is, when do you time your re-entry? So they lost money.
Yeah.
That was bad. And that's what happens in our markets. There's so many financial advisors out there. I hesitate to say, and I'm going to get castigated for this, but they shouldn't actually be doing what they're doing. They don't have the skill, they don't have the experience, and they don't have the psychological makeup to be a pillar of solidarity and strength in the relationship. You know, we hardly had any phone calls over COVID. We were still then going to the odd live presentation, interacting with other advisors, and they'd come to Garth and I and say, gee, Peter, Garth, how are you dealing with all the phone calls that are coming in from clients now? Everyone's panicking. And I looked at Garth and he looked at me and we said, what phone calls? We didn't
Maybe
get any.
one or two, but that was
We hardly got any.
Yeah.
Because, you know, we did the job properly. And, you know, getting back to this whole sentiment thing, you know, we saw the opportunities, we repositioned. I'm not going to regurgitate and repeat that because, yeah, we are proud of it, but I think the trumpet blowing session is over. Now we've got to look to the future and make sure we can repeat the successes that we've enjoyed. But, you know, we're rational, clear thinking, patient, and, you know, we instill, or we try and instill confidence in clients, and they have grown with us. I've got relationships going back nearly 40 years, and where clients used to be panicky and obsessive, they've said to me, Peter, we trust what you guys are doing. We have confidence in your process. Do whatever you have to do.
I think just to add to that, Dad, you know, you say you need to be level-headed, but you know, fortunately for us, it's not just one person who's making this decision. We have a bit of a team. It's not just myself or my dad or Alex that are making the decisions. It's actually, we've got a whole team backing us, and that will just lead me to the next thing, is that we will put out a video again soon, introducing one of the other team members that we rely heavily on. His name is Ronnie Retief, and he works for 2IP. So I would kind of use this opportunity to just introduce what we're going to be bringing to you in the next video, and that you can actually meet another team member of ours, and that we don't actually make these decisions in a silo on our own. We have other people that we can run ideas by, and we can, you know, if one of us doesn't have a level head at the time, there's a few others that will, you know. So it's not just individuals that we're dealing with, that you're dealing with, that you've trusted. It's a whole team of us. And I think that can bring you an extra level of comfort in knowing that there's multiple people thinking about your investments all the time. I don't know if you want to add to that, but just in future, in the next month or two, we'll bring you another video introducing Ronnie, and I'm pretty proud to introduce him to you.
Garth, there's not much I can add, but I look back to when we first met the fellows from 2IP. 2IP is an acronym, Independent Investment Partners, and they are an independent, standalone research house. That's all they do. They research macroeconomics, microeconomics, portfolio construction, management research, due diligence. I'm rattling on about all these different concepts. But this is what goes into portfolio construction and building a portfolio that's going to do the job. So we're very confident on the infrastructure that we have, the relationships that we have, the independence, and I can't stress that word enough. They're not bound by a big daddy where you have to place certain amounts of business with the mothership.
Yeah.
You don't have to do that.
Yeah.
We are independent. We've got people knocking on our doors from different fund management houses. Oh, wouldn't you look at this fund? Wouldn't you look at that fund? In the old regimen where we used to operate, we'd entertain these things, we'd talk to these people, and they'd give us a heck of a story and sell the story, and we would get beguiled into actually using the funds. But that's hit and miss. But that kind of process and mindset still dominates today, and it's wrong.
Yeah.
So we rely on, we now are labouring the point, but logic, reason, rationality, independence, and the funds that we use are there on merit, and there's no outside influences or incentives or anything. They're there on merit, and they stand on their own 2 feet.
Yeah.
And that in itself is another very important differentiating point that we can claim to benefit from. And we've grown since we've started interacting with these people. There's Francois Serrier, who does all the macro stuff. He looks at what's going on around the world. He interprets economic trends, whether it's inflation, interest, currencies, geopolitical stuff. These are things people don't understand. This is what goes into building and managing effective and efficient portfolios that deliver. Other guys, so a broker consultant will come and sit with you, and they give you a story and you invest in the fund.
Yeah.
Very difficult to defend that kind of fund selection when things go pear-shaped and you've got to stand up in a legal environment, because that's what's happening as well. People are getting cheesed off with their advisors who panic. They haven't lost money, but in a way they have, because they've locked in their losses. Their portfolios came off, everyone panicked, you sell. And then you go into a money market fund or something like that. And now you've missed the boat. Now people are starting to whinge, and I think justifiably. So now the legal fraternity are starting to get busy in this area. It's not an easy environment.
It's one of those stories where, there's a few that make it difficult for everyone, even though a lot of people are doing the job well. I mean, there's a lot of good advisors out there that are doing good things for their clients, and unfortunately we tend to labor the negative because it's only a few of them that will ruin it for everybody. And that's why our industry is so fraught with compliance. We have to comply with so many laws and so many bits of legislation just to stay in business and to keep servicing you. So, but I think that's a wrap, Dad.
I think
but
so.
Just in closing, I'd just like to say we really appreciate you guys sticking with us. This is a journey that we're on together, because ultimately our success is joined. So if you're successful, we're successful. And that's the most important thing. Our objective is the same. We want to see the best outcome for you. And in doing that, we become successful as a business, and we become better advisors for it. So I just want to thank each and every one of you for sticking with us and for continuing to trust us. And I know it's been a really tough year for a lot of families. We've seen it this last 18 months in a couple of families that we deal with. There's been some very difficult situations and tragedies, So I just want to encourage you all to hang in there. Unfortunately, we have the looming ESCOM again, load shedding, but I encourage you all to use the time wisely with your families. Maybe instead of watching TV, have that candlelit conversation or play some board games, But stick together and think about what's most important and hang in, because we're all in this together. It's a bit of a hiccup in the history of the world, but we're all in this together. And I just want to wish you, each and every one of you, all the best for what's coming in the future and for your families.
So just 3 little points I want to make. So I think history has proven that we as South Africans are extremely resilient, resourceful, and adaptable. Peter Durkheim once said, adapt or die. And we have that capability. We have come through tests of epic proportions over the years. And here we are. We're still enjoying our country, notwithstanding. The other thing is, and it's just a phrase, it's not about timing the markets, it's about time in the markets. So time and patience and fortitude are very important. And one last thing I want to say, and it's a little philosophical, but when I first started in the industry, and when was it, 1980, so 41 years ago, I started with Old Mutual. And their sort of slogan was Latin words, amicus certus, a certain friend in uncertain times. And I think that's how we'd like to position ourselves in your lives. Thanks very much for listening.
Yeah, and all the best. Till next time.